Good afternoon and welcome to the Asian Midday Market Watch. Our guest today is David Kuo, founder of the Smart Investor, and he's coming in to us out of Singapore. David, as always, great to have you on the show.
Yeah, thank you so much, Brian. Just like the 190 bus that I catch to Chinatown, you either get nothing for a long time and then suddenly two come along at once. So you've got me twice this week.
I know, we're really happy to have you on board. But before you get your sagely advice, David, let's take a look at how crypto markets are performing and then take a look at regional markets. Now, with crypto markets, we've got Bitcoin, which is at 43,100. It's down 1.6%. Ethereum is at 3,065.69. It's down 3.27%. Now, across the region, markets in Japan are closed today for a holiday, but we start with the SGX. The Straits Times Index is at 3,406.35. It's up 0.14%. The KLCI is at 1,573.16. It is up 1.9%. The Shanghai Composite is at 3,491. It's up 0.17%. The ASX All Ordinaries is at 7,523.1, down 0.95%. The Hang Seng is at 28,833. It's down 0.34%. Rounding up the numbers, we've got the Kospi, which is at 3,754.72, down 0.62%. David, what's your view on how markets have performed in the first half of the day?
Well, all I can say is, Brian, is that the Asian markets seem to be taking the massive fall in America in its stride, or in their stride over here in Asia. Some of the markets that I'm particularly interested in, such as the KLCI, the Hang Seng, and also the Straits Times, are up, which is kind of surprising when you saw what happened over in the US. I mean, both in terms of the NASDAQ and also the Dow. So maybe investors are moving to Asia at the moment in search of probably higher yields, given that interest rates over in America could go in one of two directions. And maybe I'll talk about that a little later on, about how people see interest rates over in the US.
And so we can't have a show today without talking about the 7.5% inflation print in the US. Now, what's your view on this and also the reaction from the Fed?
Well, the thing is, we know that there is inflation in the system. Anyone who has been reading company reports will know that there is inflation in the system, because one company after another is telling us about inflationary pressures. But I think 7.5% is particularly shocking, given that the market was only expecting something in the region of about the high 6.9s or maybe the low 7.1s. And then suddenly you get this 7.5% print, which has caught a lot of people off guard. What is really worrying, though, is that some commentators still believe that the Federal Reserve is unlikely to hike interest rates as much as 0.5%. I know there was one former Fed governor who was saying that interest rates should go up 1% at the next meeting, and then maybe by 2% within the next 2 or 3 months. But he is right. I mean, interest rates should go up fairly quickly. But unfortunately, I think the Federal Reserve will keep on leaning towards saying that these inflationary pressures are, I wouldn't say transient. They've dropped the word transient, but they're saying that it's caused by distortions in the market, distortions such as supply chain disruptions, maybe a surge in demand by consumers, and that is pushing up inflation. So what they're saying is they need more data before they actually react to this 7.5% increase in inflation. But there is another school of thought, Brian, and this is one that I kind of subscribe to, and that is that we know that governments around the world have borrowed huge amounts of money in order to somehow quell this pandemic. They've borrowed money and they've actually pumped that money into consumers' pockets in order to try and save the consumers. But this money has to be repaid at some point in time. The problem is it's almost impossible to repay that amount of money under normal fiscal measures. So if you borrow trillions of dollars, how are you going to repay that debt? And the
So you
answer is, I
inflate
don't
the
think you
debt.
can. Well, it is a huge amount of debt, but it is impossible to repay that amount of debt, not without creaming, the households and consumers. And consumers are under a lot of pressure with inflationary pressures already. The last thing they want to see is a hike in income tax rates in order to try and sort of repay this debt. So what are governments left with? And that is to let inflation whittle down that debt. And there was a time when you had $1 million and it was an awful lot of money. I mean, it's still a lot of money today, but it is not as much today as it was, say, 10, 20 years ago. So I think what will happen is that governments will allow inflation, or they will somehow maybe prompt central banks to let inflation rise so that that debt can be whittled down with the help of inflation rather than try and pay it off.
So, David, what does this all mean for Asia and Asian markets and currency markets in Asia?
Well, the thing is, if America were to increase interest rates severely, then I think it would have an impact on Asian markets, their currencies here in Asia. I mean, if you see interest rates going up in America and interest rates not going up as much over here in Asia, then there is a likelihood that somebody with a lot of cash parked in, say, Malaysian ringgits or Chinese yuans or Sing dollars or even Australian dollars might say, why do I want to leave it in the local currency when I can get a better rate of interest over in the US? So we could see an outflow of cash into US dollars. That wouldn't be great for Asia, but given that the Fed may not increase interest rates as much as we think, I think those currencies are going to be relatively stable. But what we need to also remember is that when we are investing, we need to look for companies that have pricing power. And I've been following a number of companies recently, one of which was Starbucks. Unilever is another one. Then we also have Coca-Cola and Pepsi. And believe it or not, the one thing that came out time and time again is inflationary pressures. I mean, Starbucks said that they have increased prices twice in the last 4 months. Right? Starbucks coffee has gone up twice in the last 4 months, and it expects, now this is the worrying part, it expects to do so, in other words, increase prices multiple times again this year. Not just once, multiple times this year. So companies are taking it on board, and they're taking it into their own hands, and they're saying, central banks aren't going to help us, we're going to have to do something about it, and they're raising prices.
But this is interesting, David, because one of the things it's going to impact is, of course, down the track earnings of companies. So companies like Starbucks and Coca-Cola, as you've mentioned several times before in your time in the show, they have pricing power. Many other industries may not have pricing power, or many other companies, and that's going to impact earnings.
Well, I mean, if a company can't increase prices, then one of two things will happen. Either they will have to tolerate lower profits, and investors generally don't tolerate lower profits unless they can see some profit increase in the future. So I think what will happen is that some of those companies may just go to the wall. If you can't increase prices and your profits are slowly dwindling, then of course, the markets being what they are brutal. And they're saying, if you can't increase prices, then you don't really sort of deserve to be in the market in the first place. But Coca-Cola was an interesting one yesterday because it said that it expects earnings to grow around about sort of 5 to 7% next year. So Coca-Cola clearly thinks that it has got pricing power, and I'm not entirely surprised, that it has. But those that can't will probably have to suffer. But I mean, Pepsi-Cola is another one, and it is saying that it is costing more to make its snacks and sodas and get them into the stores, onto the shelves of stores. So it's seeing pricing power in terms of the raw material that it requires, plus also the logistics, in other words, the transportation costs. And it also will have to increase prices because otherwise its goods aren't going to find themselves onto the stores. And so therefore, your favorite snack, maybe, Brian, Frito-Lay, may either have to cost more or it's not going to appear in the store shelves.
Now, David, as always, thank you very much for your insights on Friday.
Thank you.
Now, we've been speaking to David Kuo, founder of the Smart Investor, coming out of Singapore on BizTech's Midday Market Watch. I'm Brian Fernandez. Please check out our video and podcast on our website, www.biztech.asia, as well as our social media platforms. Thank you very much for tuning in.